Wondering why the crypto market seems to swing up and down so much? You're not alone. It's one of the most talked about mysteries in investing. In this video, we're explaining the main reasons behind crypto's price changes and sharing what you can do to stay smart and calm through the ups and downs. Before we dive in, be sure to like, subscribe, and hit the notification bell so you never miss easy, real advice for navigating the crypto world. Let's get into it. Market psychology and emotional trading. Emotions play a disproportionately large role in driving cryptocurrency markets, much more so than in traditional financial markets. While all markets are influenced by investor psychology to some extent, the crypto space, still relatively young and dominated by retail participants, is especially vulnerable to emotional decision-making. Feelings like fear, greed, FOMO, fear of missing out, and panic often override rational analysis, leading to extreme price volatility. In traditional markets like stocks or bonds, institutional investors such as banks, hedge funds, and pension managers make decisions based on deep research, technical models, and long-term strategy. In contrast, the crypto market is still heavily populated by individual retail investors, many of whom are new to investing and lack experience in managing risk. As a result, prices are often dictated more by herd behavior than by fundamentals like adoption, technology, or utility. For instance, when Bitcoin or another major cryptocurrency hits a new all-time high, this triggers a surge of interest from casual investors who fear missing out on future gains. This FOMO-driven buying spree can push prices even higher in a short period, creating unsustainable bubbles. But when the market inevitably corrects, or even slightly dips, panic selling quickly sets in, especially among those who bought near the top and fear losing their money. This causes sharp crashes, often with no connection to any real change in the underlying value or utility of the asset. One of the unique accelerants of emotional trading in crypto is social media. Unlike traditional finance, where market news is delivered through regulated channels and mainstream financial news outlets, the crypto world is heavily influenced by platforms like Twitter, X, Reddit, TikTok, and Discord. A single tweet from an influential figure such as Elon Musk, a prominent investor, or a well-followed crypto personality can instantly sway public sentiment and cause billions of dollars to flow into or out of the market. These emotional responses often happen in real time without proper due diligence or verification. Low liquidity and market manipulation. Despite billions in daily trading volume, cryptocurrency markets still have relatively low liquidity compared to traditional financial markets. This means large trades can cause significant price movements. When a major holder sells a substantial position, it can crash the price, triggering stop losses and liquidations that accelerate the decline. Conversely, large purchases can rapidly drive prices higher. Market manipulation is more prevalent in crypto due to less regulatory oversight and the concentrated holdings of early adopters. Whale wallets holding thousands of Bitcoin can influence prices through strategic buying or selling. Coordinated pump and dump schemes are common in smaller altcoins, where groups artificially inflate prices before selling their positions to unsuspecting investors. Regulatory news and government actions. Regulatory announcements create some of the most dramatic price movements in cryptocurrency markets. When China banned Bitcoin mining and trading, the market lost over 50% of its value within weeks. Conversely, news of potential Bitcoin ETF approvals or favorable regulatory frameworks can drive massive rallies. The uncertainty around global regulatory approaches keeps markets on edge, making them highly sensitive to any government statement about cryptocurrency. Different countries taking opposing regulatory stances creates ongoing uncertainty. While El Salvador adopts Bitcoin as legal tender, other nations consider complete bans. This regulatory patchwork means crypto markets must constantly price in political and legal risks from multiple jurisdictions simultaneously. Institutional investment flows. Large institutional investors moving in and out of crypto positions create significant market movements due to the size of their trades. When institutions like Tesla announce Bitcoin purchases, it validates crypto as a legitimate asset class and drives prices higher. However, institutional selling can be equally dramatic. When institutions liquidate positions for risk management or regulatory reasons, it can trigger major market downturns. Institutional investment flows often follow risk-on, risk-off patterns tied to broader economic conditions. During economic uncertainty, institutions may reduce exposure to risky assets, including cryptocurrency, contributing to sell-offs. Conversely, during periods of economic optimism and low interest rates, institutions may increase crypto allocations as they search for higher yields. Technical factors and market structure. Cryptocurrency markets operate 24/7 without circuit breakers or trading halts, that exist in traditional markets. This means price movements can accelerate without pause, leading to more extreme volatility. Automated trading algorithms and high-frequency trading systems can amplify price movements, especially during low-volume periods like weekends or holidays. Leverage trading is extremely common in crypto markets, with some exchanges offering 100x leverage. When prices move against leveraged positions, forced liquidations create additional selling pressure that can cascade into major price crashes. These liquidation cascades often happen rapidly, causing flash crashes that can wipe out billions in market value within minutes. Macroeconomic factors and global events. Cryptocurrency markets increasingly respond to macroeconomic factors like inflation rates, interest rate changes, and currency devaluations. Bitcoin is often viewed as a hedge against inflation and currency debasement, so inflation data and central bank policies can drive significant price movements. Rising interest rates make yield-bearing assets more attractive compared to non-yielding cryptocurrencies, potentially leading to crypto sell-offs. Global economic uncertainty often drives crypto adoption in countries with unstable currencies or banking systems. Economic crisis in major economies can either boost crypto prices as people seek alternatives to traditional financial systems, or crash them as people liquidate all risky assets for cash. What you can do: practical strategies. Dollar cost averaging is one of the most effective strategies for managing crypto volatility. Instead of trying to time the market, invest fixed amounts regularly regardless of price. This approach reduces the impact of volatility by spreading purchases across different price levels over time. Set up automatic purchases weekly or monthly to remove emotional decision-making from the equation. Diversification across different cryptocurrencies and asset classes helps reduce portfolio volatility. Don't put all your money into one cryptocurrency, and don't put all your investment capital into crypto. Maintain positions in traditional assets like stocks and bonds to balance your overall portfolio risk. Set clear risk management rules and stick to them. Decide in advance how much you're willing to lose and use stop-loss orders to limit downside risk. Never invest more than you can afford to lose completely, and avoid using leverage until you have extensive experience and risk management skills. And that's why the crypto market goes up and down, and how you can handle it like a pro. Remember, staying informed and patient is key to weathering the crypto roller coaster. If this helped clear things up, give it a thumbs up and share your thoughts or questions in the comments. And don't forget to subscribe and hit the bell for more simple crypto tips. See you in the next one.